putting it up in case you want to see it on streaming and not download the thing. I'm putting it up on my YouTube channel also. Just note the channel that I'm using is Ram Ritvik Sen only, not underscore DSP. I noticed that Rohan has joined the old channel, which is underscore DSP. So that I had to discontinue in between. Ma'am had stopped, forbidden us from recording the sessions. So I had to stop. Okay, so let's now dismiss this. Okay. Now I had to migrate to this new channel. All right, so it's on the Ram Ritvik Sen only channel. You'll find it's a public playlist. So if you prefer to watch it on YouTube, you can do it there. I generally try to upload by the end of the same day. But anyway, okay. So here we are with this. The first point. Okay, the first point. There's going to be a quiz. Okay, there's a quiz coming up. Please watch out. Get ready with your prep. I will try to give you at least 2 to 3 days notice, and there will be a quiz. I'm going to try and do it on Microsoft Teams itself, and not on this platform. Okay. And so we're going to have a quiz, and so please, and the quiz syllabus is going to be basically from the day I announce it, whatever we have covered up until that date, that's your syllabus for the quiz. Okay, it'll be similar to what happened in lab. It's going to be very tight in terms of time because I have to ensure that nobody has a chance to cheat. So that's why it's going to be very, very tight. It's going to be like the cat, and it'll be multiple choice, and of course the questions will be jumbled up. And please watch your submissions. We had a real big disaster in lab the other time where people, if the submission time is 12:15, okay, so this is before we start this, I'm just going through some of this. Before we start this book coverage, we are going through some of the administrative matters. Okay, now we had this problem. If the quiz is ending at 12:15, you don't submit at 12:15. You submit at 12:14, maybe max 12:14 and 30 seconds or something like that. Because at 12:15, the door is already closed. We had a bunch of people submitting after 12:15 or at 12:15 and saying the door is closed. Of course, the door is closed. So you have to watch it because we have to put time pressure in order to ensure no one cheats. So it's going to be very tight. So please make sure you watch your submission properly. Okay, submit it like at least a minute to 30 seconds before the actual deadline approaches. And sync your clocks properly to some kind of peak clock or something like that. Don't go by your own mobile phone timing. Okay. So, right, what are we going to talk about? We're going to talk about, so that's the first point, okay? So quiz is coming. Please be ready. Please revise whatever has been taught. The quiz is coming, and the quiz will cover everything, okay? So if there's something I'm discussing with Kushali at the end of the session, then whatever I've discussed, whatever's in the video is part of your syllabus, okay? That's the rule. Whatever's in the video is part of your syllabus. Even if the class has been dismissed and I'm discussing something with Isha or Kushali or Sanchit, that all that is included in your syllabus, okay? Because we're not discussing anything other than investing. So you have to know that, all right? So that's one. Now, second, I just wanted to give you a little bit, it might improve your writing. We were talking about divergences the other day, so every time I hear this word, I remember this poem by Robert Frost. He's an American poet, very famous poem. Actually, it has implications for your career as well. So this point, I was trying to make this point about divergences. So divergences means one goes one way, the other goes the other way, from a point of common travel. So here's this famous poem. Okay, and here this line is very famous. Okay, two roads diverged in a yellow wood. This is famous as well. But what you mostly see, this is actually passed into the language, so you can put it into your writing. And this part, two roads diverged in a wood. This part especially, I took the one less traveled by, and that has made all the difference. Okay, so that he's talking about that he took the one that was less traveled. So which is basically saying that you take an unconventional path, and that has made all the difference. So this poem is actually called the road not taken. Okay, but very often in English we say we talk about we use this expression now. It's come into the writing, into the language as well. So you just say the road less traveled. Okay, so if you're talking about somebody who has done something a little bit unusual or unconventional or contrarian, you say that you take the road less traveled. So if you have, let's say, for instance, everybody's bullish on Tesla, and you want to put out a bearish report on Tesla, if you're an equity analyst, you can even go along these kind of lines and talk about the road less traveled. You can say I tread the road less traveled. So that would be one way of using this thing. So I just wanted to, because this divergences always reminds me of this poem, two roads diverged in a wood. So I just wanted to share this with you. And we should always be willing to jump from one discipline to the other. And language is always very important. Okay, so we can get out of this here. I put the link for you. You can read it yourself if you like it. Okay, so that's number one is quiz. Number two is this connection to divergences. Now let me come through. If you look at your student folder now, there's a file in there called Project Brief. Okay, this is your 30% project. The quiz is going to be 20%. The project is 30%, and the end term is going to be 50%. All right. So now let me talk to you about so quiz. Is going to be whatever the syllabus is on the day whatever has been covered on the day that I announce the quiz, the actual date of the quiz. Now here in the project brief, you'll find this. It's a read-only file for you. Okay, so let me just go through this. This is a comprehensive equity research report. It's a little unusual because normally equity research reports are not, they do not include both fundamentals and technicals. So everybody understands by now what is to be done. Okay, before that, the project student groups. Some of you were a little sloppy coming up with your names. I saw Chandrakant, I think your group had three people, right? But Chandar hadn't put his name as the team leader, so I put Chandar as the team leader. This one's okay, your group. Chandar, Chetan, and Mansi is okay. That's what you meant, right, Chandar? Is that what you folks had meant? Yes? Anybody? Chetan, Mansi? No response? Okay. Yeah, okay. So now these three had not put in their names, so I've just put all of them into one group. Okay. So now you can't complain. Since you couldn't get married on your own, I have forced you into an arranged marriage. Now you can't complain anymore. So now this is the setup now. Everybody has the Home Depot for these guys, Procter & Gamble for Chandar, and the rest you already knew from before. Okay. So we have a total of 46 students, okay, because we had 40 earlier. So this is the setup. So each one of them, so Rohit's group will be preparing their report on Home Depot, and so on and so forth. Okay, is this part clear to everyone? Who has what stock to cover? Everyone knows. Everyone's clear about this. Yes. What happened? Aditya, are you clear? Aditya Jain, are you clear about what is required here?
Yes, sir.
Okay, great. Everyone's clear, I presume. Okay. So here, don't do this. See, if you go into industry and do this, people will have a negative impression about you. See, Ankit Jain has not put it in a proper way. This is not how you write your name. Okay, write it like this. That's right. So this, what will happen is if you do this kind of work in industry, people will think you're sloppy. You have to be careful about these little things. You see, when I put out my stuff, you see how neatly arranged. By and large, it's quite neatly arranged. So it has to have a good look as well, a decent look where whoever's looking at it should not kind of create visual dissonance for them. Okay, so these are your teams. Your assigned stocks. What you have to do is you will write this comprehensive report. Yeah, these are some fairly obvious now. Okay, please follow the instructions. Okay, create a G Drive folder, share faculty into the folder, etc. And please use your use a folder like just name the folder like this. Let's say so Rohit's team can write Rohit R. Okay, I think that's fine. I just write Rohit R is fine. Team leader's name is fine. You don't need to write anything else. Okay, so because that's if you share me into it, that should be good enough actually. If you just share me into it, but in the way it's actually not a bad idea. Just write Rohit R underscore IPM 21. So Malika will write Malika S underscore IPM 21. Just put this folder and then put your create your document. You can work on these two files outside your the folder that you share with me. This you can share at the end. Better to learn to work directly in GDocs. I find everybody is still very much stuck in the old world of working offline. I think for this project, I'll force you guys to work online so that you get used. This is also something to learn. to get used to working completely in the cloud, because this is the world of tomorrow. Okay, everyone's on the cloud. Nobody's got stuff on their hard drive. So get used to this. Use Google Sheets. Very versatile. Pretty much has everything you need. If you get really stuck, you can't get something you get in Excel, then you can just upload Excel, but make sure your upload settings are such that it will convert. Okay, so here you will convert under, I think this is the drive settings. You can convert this, yeah, convert uploads, convert uploaded files to Google Docs editor format, let it be checked. Okay. Do that so that then the Excel file gets shown as a GDoc file, because it's much easier to manipulate actually. So in even your Word document files. Okay, so these are just the administrative matters here for submission. Okay. Now, yeah. So whatever work you have to do in spreadsheets, okay, you will have to do a lot of work in spreadsheets. Keep the spreadsheet separate. Don't like this one here. This is a separate spreadsheet. This is a separate spreadsheet, and this is my report. Let's say. Don't embed the spreadsheet into the document. It looks horrible. Actually, it's much better when you see it separately as a full spreadsheet. So just keep it separate and refer to it in the document. So if I've got table 1 as one of my first sheet is table 1. So I'll write this as table 1, or I'll put table 1 in the title here. Okay, and just name your sheets also table 1, table 2, etc. And then here you just say table, look at table 1 or reference table 1. Just put table 1 in brackets. So use that in the reference of the document. Okay. Now in the report, don't write facts. Don't just repeat facts or anything that you just left out from the annual report or something. Just write analysis. Only write analysis. No need to repeat the facts. The facts are known to me. So these are the parts that I need in the report. If you want, you can put in some more parts. But this is what is required. A summary, just like an executive summary. What is your recommendation to buy, sell? Sometimes they say hold, but this hold is kind of stupid actually. So I would recommend don't put hold. Okay, it just shows like there's no view. Buy or sell is good enough. But there's this very bad culture in the equity analyst community, right? Hold means you don't really have a view. So price target and what is the risk point? So if you have a price target, and then let's say for instance, in the case of Disney, so I've taken Disney because it's not really anybody's stock. Okay, so now it's almost gone to 200. Suppose you have a price target. Usually the price target that they give is a 12-month price target. Okay, so that's the convention in the industry. So you can also do that. Okay. Now what is not normally given in the industry is, so here's where we are departing from the industry convention. There's hold, buy, sell, hold also, but we're not using hold. We're only going to write buy, sell. Then we have a 12-month price target, fine. And this one is not given in industry analyst, in the equity analyst reports in the industry. They don't give a risk point, okay? But you should give a risk point because otherwise it makes no sense. If you just say my 12-month price target for Disney is, let's say 300, all right? Now then the stock starts falling. So excited about your recommendation, excited, with the, by the prospects of gains. I buy Disney at say whatever the price is, 175, because you said it's going to 300, and then it starts dropping 160, 150, 128, 90, 80. I mean, at what point do I mean, you said 12-month price target. I mean, if it's kind of at 40 or something, or 50 by in 10 months, it's unlikely it's going to 300 in the last 2 months. So I've lost so much money. So this is very irresponsible actually, because these guys don't have a sense of having a stop loss. That's not the right way to give recommendations. So you should also have a risk point for your view. So if you have a target of 300, practice getting into this habit of, because in real life, you can't really operate like that. Now, if you have a very short-term focus, your risk point would be somewhere here, where if this support breaks, then you have this sequence of higher highs, and higher lows, which is the definition of a trend. Low, higher, low, higher, low, higher, low, high. And all the highs are higher. If this breaks, then the pattern of higher lows and higher highs will be broken. So this would be very short term, of course. Typically in an equity research report, you would not have such a tight thing, but there's no reason why you can't. Okay? So maybe you can have something else, like maybe It is based on some kind of other fundamental news. It could also be based on some fundamental news. But generally, there should be a price-based risk point. Like if it spends more than more than 3 months, you can decide. If it spends more than 2 weeks below 150, something like that. Something concrete should be given, which gives the investor a warning that your analysis is not, your assumptions are breaking down. So basically, you need some kind of a point where when you know that your assumptions are breaking down, so you need to get out of whatever you did, right? So it's common sense. If you do something in life based on certain assumptions, then once those assumptions break down, you should try to unwind that course of action if it's possible. Sometimes it's not possible, but in this case, it's possible because you bought Disney based on certain assumptions that streaming is really going to take off or all kinds of things. So you can put those kind of conditions as well, but it should be concrete. It should be something measurable, that they have not reached 20 million subscribers in streaming within the next 6 months. If they don't reach 20 million subscribers by the next quarterly report, then get out of the stock. Something specific which the investor can watch out for and use as a trigger to get out of a position. All right, you get the point here. So this would be, for instance, in a technical, very short-term focused technical view, it would be this, because if I'm buying here, you can see how the stock is related to the breakdown of assumptions. See, suppose I'm buying here because I think it's an uptrend and it's going like Aditya. I'm a momentum investor, so I see no destruction of the trend. All right, so there was a little bit of a hiccup here, but then because of COVID, there was a little bit of a hiccup. The net is, for some reason, it's not reacting to my click. Okay, doesn't matter. So there was some kind of there was a little bit of a hiccup because of COVID. There was a little bit of a hiccup. This the one? Yeah. Okay. So there was a hiccup because of COVID, but then again, it's streaked up to new all-time highs, and I see this going higher and higher. So when I buy the stock, what am I actually saying? If I buy the stock, obviously that means that I expect the stock to go up, right? So if I expect the stock to go up, and I guess I would expect it to make fresh highs, okay? That's what we would normally expect, that it would make fresh highs. So therefore, that means fresh new highs. So that would continue the pattern of higher highs and higher lows, because you see from here low, 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 and this would be the next low, from which it would make another new high. That would be new high, higher high, higher high, high here. All the highs are higher, all the lows are higher. So that means it's an uptrend that is going to continue. So which means you can actually say that by looking at my actions, so I decided to buy Disney. By looking at my actions, you can infer that I believe that the uptrend is going to continue. Okay, so this is what I mean by assumptions. By looking at my actions, you can clearly infer that my assumption is that this uptrend is still continuing. This uptrend is still continuing, and it will continue to make higher highs and higher lows. And that's why I'm buying in the expectation of fresh highs. So the moment this breaks, that straight away it punctures my assumptions. Can you see that? The moment this breaks, because now if you have a new low, let's say at 140, now you can no longer say that there's a sequence of higher lows and higher highs from here. Okay, I did not teach you this earlier, but we are learning it as we go along. That the definition of an uptrend is higher lows. It's very easy you don't have to remember. If you practice it a few times, just look at any chart, you will see these trends and you'll be able to figure out what it is. For uptrends, it's higher highs and lows. For a downtrend, it will be lower highs and lows. Okay. So here uptrend is higher highs. So the moment you see a break to 140, let's say, okay, or anything below this, then if you have a new low at 140, then immediately that low is lower than this. So you can no longer say that we have a pattern of higher highs and higher lows, because the higher lows rule is broken, right? So therefore, you can see that this uptrend is broken, which is what? But what was my assumption when I bought this? My assumption was obviously I'm buying because I think it's going up. And to be more specific, that means that I believe that this uptrend, which is the post-COVID rally, this uptrend, which began from March of 2020, that rally is still going on. It's not complete. It's not over. It's still going on. And it's going to keep on making higher highs and higher lows. And that's why I'm buying. And the moment this gets taken out, that assumption is punctured straight away. Your assumption is destroyed. And that's why you have to get out. So understand the logic also of technical trading, why the stop is placed here, because this is the point where your assumptions are invalidated. Is everyone clear? Has everyone understood so far what I'm talking about here? Why you have a risk point? Yeah, everyone clear?
Yes.
Okay.
No, sir.
Okay, great. Okay. So it's important to understand the logic. Yeah. Yes, ma'am?
Sir, can you just repeat about this higher lows? And because sir, why we are taking the resistance point at 160, we can also take the resistance point at 120 also.
Yeah, you're right.
Yes,
And okay, 1 minute, man. The word is not resistance. This is support. These are
support, yeah.
supports actually. These are supports. Okay. This was a resistance, and then it got taken out. This used to be a resistance where the COVID decline happened, and then it got taken out. So what you mean is actually support, not resistance. Okay. So these are the points of support. Okay. So you're absolutely right. This could also be 120. I'm just taking the one that is nearer because then my risk is less. So you're not wrong. You could also use 120. But then you have to remember that if it does go below 120, then whatever this point is, okay, let's call it 120. If it does go below 120, now you're entering at 175, yeah? So you're losing like 55. Whereas if I put it at around say 160, then I'm losing 15. You get my point?
Yeah. Yes.
Yeah, yeah. So yeah, you're absolutely right. This is a matter of choice, but I choose this one because it's closer and it's a clearly defined low. And this actually is, see, the other problem with what you're suggesting with 120 is you can do it if you feel that this is not visible to you on the scale that you see. So the degree of magnification is very important actually. The degree of magnification is very important because if you see, when I zoom out, I can't see all that. Can you see this? Now, what all that up and down we were looking at, in this kind of chart, it's a monthly chart, I guess. Here you can't see all that detail. You notice that? In the post-COVID rally, you can just see pretty much only one straight line. If you go a little bit like this, then maybe at this point, when you're doing this kind of magnification, there Mayan's point becomes more relevant because here you can't see that 160 so well. Actually, it's a little obscured by this Disney display also, the ticker display. But let's assume you can't see the 160 thing because it's not sufficiently, it's a monthly chart, but you can see the 120. So it depends on the scale that you're using, the magnification scale, the degree of magnification that you're using. Here it's just, you can see, it's just, it's like, it really looks like one straight line. It's only when you go into 5 years, now what have you done? You have actually zoomed in. So it's a matter of, you can think of it as like a photographer, you're zooming in and zooming out. So we can call this, instead of using a big word like magnification, we can call this the degree of zoom. Okay, so that'll just make it clearer, and it's a shorter word to use. So we can just call it the degree of zoom. So the degree of zoom is very relevant actually, because it determines what you can see. Now, if you zoom in further, you can see even more detail between this and this also. Right now, this part here, this thing looks like just one straight line. But if you go in and zoom in further, you will get like this is the weekly chart. Okay. If you go and use shorter term charts, you will see greater detail between here and here also. So all that, so this is very important. And so generally what I advise is that your key decisions should be taken on one fixed degree of zoom. Like if this is the zoom that you have like a 5-year display, okay, in this chart, in this charting application. So keep the same kind of, I mean, you can look at different degrees of zoom, but your relevant for setting the stop, the relevant degree of zoom, generally you should keep it the same so that you don't get confused between, because the picture will be quite different on different degrees of zoom. If you go back, see, if you look at it this way, now everyone will agree with me, it's fairly obvious that I want to choose the earliest point at which my assumption is invalidated. So in response to Mayank, while I told him that he's correct, but in this display, actually, he's a little less correct than my decision here. Okay, he's a little less correct than me because logically, you should be out at the first sign of trouble. Okay, at the first sign that your assumptions have broken down. So I think everyone will agree with me that on this display, on this degree of zoom, we can see one high, second high, third high, fourth high. You can see one low. We can kind of argue about this, but okay, second low, third low, and fourth low, right? Pretty much everyone agrees. No one really anybody disagrees with this. Reasonable marking of highs and lows, right? So the reason I would say Mayank's point on this display, okay. Now, if you go back to the all display, then Mayank is more likely to be right because it's actually the only reasonable stop will be at 80 because you can't see anything else. Okay, you can only see the low at 80, but here we can see a lot more. So this decision is better than this decision because when it breaks through this, you already know that your assumption is invalidated. All right, because you assume that there is an uptrend and the uptrend is continuing. The moment the uptrend is, just to come back to Mayank's request, repeat the highs and lows. Okay, the theory about the highs and lows. We define an uptrend as a sequence of higher highs and higher lows. Okay, as I said, just pull up any chart and you can remember what the definition is. Don't try to memorize it. Okay, draw the picture in your hand. Draw the picture on a sheet of paper, and then write the definition. Don't try to memorize it. Higher highs and higher lows. You look at any uptrend, it will be the same. So this is higher highs and higher lows. So the moment that the sequence of higher highs and higher lows is broken, the uptrend is no longer valid. Are you following? Okay, the uptrend is no longer valid because in order for the uptrend to be valid, you must have a sequence of higher highs and higher lows. So the reason this is a better stop than this on this degree of zoom, okay, on this I'm qualifying the remark, and on this degree of zoom, is because this is the earliest point where you know that your assumption is invalidated. So why would you wait till here? If your assumption is already invalidated, you should get out right then. And don't wait for here because I mean, if this is gone, then this could also go, right? It doesn't mean that this will always go, but this is already your assumption is invalidated. Is this point clear, ma'am?
Yes, sir.
Yeah. So therefore, you have to always work on the basis. So you have to be very clear about this. As I said, remember this point when you're practicing technicals, that your critical decision in terms of selecting the stop. Okay, there must always be a stop. So if I'm teaching you anything, yes, Sanjit, you have a question.
Yes, sir. I have a question, sir. Suppose
Yeah.
a company at the price 120 lows, and
But
there are
your
some.
voice, 1 minute, your voice got garbled. I didn't hear after company. I couldn't hear you.
Sir, am I audible right now?
Yeah, you're audible. Yeah.
Yes, sir. So, sir, suppose a company, Walt Disney, at the price of 120 at their lowest, there
Yeah.
are something happened who uh, which affects the long term,
Okay.
which affects whose consequences are long term. So, uh, uh, when we choose 160 as our higher lows,
Mm-hmm.
so may I speak in Hindi?
Okay. Yeah, but actually, you have to practice speaking in English. But anyway, in this case, you can do that since you need to make your point.
Yes, sir.
Yeah.
Yes, sir.
Hmm.
सर सर सपोज जब वर्ल्ड डिज्नी का प्राइस 120 पे था, तो उस टाइम
हाँ.
पे कंपनी में कुछ ऐसी चीजें हुई होंगी जिनका अफेक्ट लॉन्ग लास्टिंग होगा,
Okay.
और आज हमने हमने हायर लोज 160 दिए हैं,
हाँ.
तो फिर वो जो 120 का अफेक्ट भी देखना जरूरी है हमें. अगर हम 160 ही लेंगे तो वो तो बिल्कुल करंट सिचुएशन का हमें आइडिया देगा, जिसका इफेक्ट आगे आने वाले टाइम पे नहीं होगा, बट 120 के पे जो हुआ होगा उसका भी तो इफेक्ट हमें जज करना चाहिए फॉर इन्वेस्टमेंट.
Yeah, okay. So what I would say to your thinking is, see, you have to practice, you have to remember one thing, that when you are doing technicals, you don't focus on fundamentals, okay? Because technical analysis is actually, the two are not compatible, although many people use both, but actually that is not logically correct. Because if you use technicals, then you effectively, what you believe is that any kind of fundamentals is a waste of time, because all the fundamentals are supposed to be reflected. One of the critical assumptions of technicals is, which you'll see when you read the books that I've given you, is that the all the information is reflected in the price. Okay, so in terms of your efficient market theory, when you're doing for those who believe in technicals, okay, so one of the things we will assume that one of the things we are going to assume is that if you are doing technical, if you're practicing technicals, you're practicing TA, that means you believe in the assumptions of TA, right? It's a fairly reasonable assumption. Okay, if you are practicing Muslim, that means you believe that there is only one God and Muhammad is his only prophet. That's a fair assumption, because you're practicing Muslim, so you believe in the assumptions of Islam. So similarly, you're a practicing, you're practicing technician. We call them technicians. Then we assume that you believe in the assumptions of technical analysis, which means one of the assumptions of technicals is that all the fundamental information is already reflected in the price. Okay, so therefore, when you do technicals, strictly speaking, although many people in the industry do both, but I'm telling you that's not logically correct. And actually, it will get you into trouble if you do it that way. When you're doing technicals, just do technicals. Don't worry about the fundamentals. Okay, when you're in the technical mode, fundamentals you should do only in equities. Well, fundamentals does matter, but maybe kind of it takes a long time. You can have some massive moves without changes in fundamentals. Yeah, Rahul, I'll come to you once. Okay. So see, it will in fundamentals again, equities, I would say don't worry so much about fundamentals, because you can have such massive price moves without any change in the fundamentals. Then you'll miss out on a lot if you try to wait for fundamentals. So equities, especially liquid markets. Now, you notice one of the things I've given you is all the stocks are highly liquid stocks. Okay, these are all very liquid stocks. So these stocks were actually selected by applying the stock screener that I've shown you, the Finviz stock screener, and that's how they were actually selected. All right. So these stocks are very liquid, and one of the things you'll notice is if you are, especially when you're in highly liquid stocks, it's pretty safe to trade purely technically. And if you worry too much about the fundamentals, you might get left behind, or you might lose money. Okay, so in general, what I would say to you, Sanchit, is what you're saying is quite understandable, because that's how most people think about things. But my warning to you would be that when you're doing technicals, you just do technicals. Okay, don't worry about the fundamentals. Okay. And the fundamentals is separate. So what you do is fundamentals. You do separately. You can select maybe some reasonable. Make sure you don't invest in a loss-making company or something like that. Those kinds of some checks. Okay, but you don't need to. I would generally say if you're dealing in liquid equities in major developed markets, and for equity markets, India can be considered a fairly developed. I mean, not exactly fully developed, because short selling, lots of restrictions. But it's a pretty good market actually. In India, the only market worth trading is the equity market. The rest is all garbage. So this is where the liquidity is actually. So Indian equities, if you look at the top 50 stocks, okay, don't go beyond the top 50. That becomes a little risky. So if you look at top 50 stocks in India, it's fairly liquid, and it's fairly safe to trade them on a purely technical basis, right? And so we assume that all the information is already reflected in the price. So we don't try to apply an overlay of fundamentals on top of this. Is this clear, Sachin? Now you're clear?
Yes, sir. I'm clear, sir.
Okay. All right. Okay. So we go to Rahul now.
Yes, sir. Yeah. Sir, am I audible?
Yes.
Sir, actually, I want to ask that fundamentally used for the longer term, right? But sir, technical analysis, can we say that technical analysis is used for the shorter term, or we
No,
can
no.
judge the price of the stock by looking at
This
the
is okay.
chart?
Now let me start putting this down on your Q&A notes, okay? Because I want you all to remember this. Okay, so today is 21/8. How are we marking it? Okay, these are very important terms, okay? These are very important points. So I think I want you to remember, okay? Let's put it there. TA assumes that all public info is reflected in, okay, now writing in the price should be the proper English. I'm saving myself some time. What is the meaning of this? Let me test your understanding of the market efficiency EMH variance. Remember I talked about the efficient market hypothesis and the variations, the flavors of the efficient market of the EMH. So what does that mean? In technical analysis, we assume that all public information is already reflected in the price. Okay. So what does that mean? The market is
Highly effective.
not effective. The word is not effective. What is the word?
Efficient.
Efficient. But I said flavors of EMH. Can you use something more to clarify? Efficient is not good enough. You need to qualify it further. The market is what form efficient?
Strong form.
Strong form efficient.
No. Strong form means that inside, what did I say? I did not say public and private info. I said public info. What is it then? What is the missing word? This is going to come in your quiz. Yeah. What is it?
And it would
What?
be semi-strong
Correct.
because
Yeah.
fundamental analysis won't be effective in this.
Correct. That's what I'm looking for. Okay. So, which means you can make all these connections. Practice making all these connections because these ideas are new for you, and these ideas are quite commonly discussed in the financial markets. So, it may come up in your interviews. These concepts need to be 100% clear. Please practice playing around with these ideas. That TA assumes what, FA assumes what, value investing assumes what do they assume that sentence structure is not correct. What does value investing assume? What does TA assume? What does FA assume? And what is the assumption of TA? The particular assumption in TA about all public info is being already reflected in the price. How does that connect to the flavors of the EMH? It means that in TA we assume that the market is semi-strong form efficient. Okay, practice playing around with these concepts and getting them internalized. Everything is about practice. Okay, everything is practice. So you have to practice a lot, and that's how you become fluent. So if you don't go and revise repeatedly, it will not. You will not become fluent in it, and then you might get nervous in the interview. Okay, so be careful. You have to put in a lot of work on revision. All right. So this is the information given to Sanchit. That so TA assumes this, and therefore, and generally, now this is not conventional wisdom because in the market most people use both technicals and fundamentals. But I'll show you why. Okay, since TA assumes that all public info is already reflected in the price, the market is semi-strong form efficient. So FA should not elegant wording here, but I'll just give the sense here. Should not supply incremental insight, right? That you will not get any incremental insight from doing FA because the market is already semi-strong form efficient. Now, all human beings have limited supply and energy, a limited time and energy, okay? And human beings don't act irrationally, so limited time and energy. Okay, so why waste it on something which will not supply incremental insight? Okay, so for a TA believer, engaging in FA is redundant and not good spelling and irrational. Okay, and therefore and thus irrational. Okay, because we do not, as human beings, we have this wording, the sequencing of the logic is not, perhaps can be improved, but I'm doing it in a hurry. So we have limited time and energy. So why would I engage in some activity which is redundant when I have limited time and energy? Because if I do FA, it will consume my time and energy. So why would I spend my limited time and energy in doing something which is redundant, which means it's superfluous, it's not going to yield any extra benefit, not going to supply incremental insight, because the market is semi-strong form efficient. Why do I know that? Because I practice TA. I practice TA means that I believe in all the assumptions of TA. And this is one of the assumptions. Okay, this is one of the assumptions of TA. And so, yeah.
Sir, like in this, you are saying, sir, so fundamentals are already reflected in the price of the stock, but the fundamentals, which are current fundamentals, but what is going to happen in future? If we can, like by the past trend, we can see that the company is been growing for 15% and on an annual basis. So that price won't be reflected in the company's price right now, right?
Yeah, because that's not public. See, the expression is all public information. So what you're talking about, the information that will come in the future, that is obviously not public because it's not yet come out, right?
Yes, sir.
Yeah. So if you you can always take a call on that. You can always take. That's what was happening in Tesla, for instance. If you look at when there was a lot of disagreement in the price. There was a lot of disagreement among analysts. So Kathy Wood was of the view that Tesla would go to 2000, and that's why she was here around this time when the stock started to take off around from interest broke above 200. If we take it here, yeah, this is where the confusion was actually. This is where it was stuck for a long time. Okay, it was actually this around this 80 level. Okay, now here there was a lot of, so you see now the breakout occurs. Here, this is where the real break starts to come as it goes above this high. All right. So these are some of the indicators that you'll have to use in your project, because I'm going to require you to use two momentum indicators. So there are certain channel breakout rules, etc., which you can apply. And so this basically where you have this kind of a break. So there was a lot of confusion around this time. If you were monitoring the market, you would have noticed there was a lot of confusion around this time, where the people like Kathy Wood were saying Tesla is going to 2000, and this was actually there's a stock split, so this price was not 53 at that time; it was something 120 or something like that. So everything has changed now because there was a stock split. So, but the point is, whatever it was at this time, whatever the low was at this time, June 19, around this time, there was a lot of different opinions in the market. So Kathy Wood was one of the very few people who was very bullish on Tesla, looking for it to go to 2000, and most of the other people were not, that didn't have very strong views. Okay, so that's an example of where she was long based on fundamentals. Okay, so that's a fundamental trading strategy. So you don't have to use. So if you're doing that, that's a fundamentally based trading strategy. So once again, what is coming out from the different questions, which is quite natural. This is how you learn and clarify your thoughts about the market. That what Mayank is talking about is actually he's talking about fundamental trading, which somebody like Kathy Wood would be doing. Okay, you can read up on Kathy Wood. She's quite a visionary in the tech world, and they have this brokerage called they're managing. It's AMC as well. They have ETFs and stuff, and I think they also manage money. It's called ARK Investments, ARK Investments, like Noah's Ark. Okay, so you can look at ARK Investments. So I'm just mentioning that. ARK Investments. You can look it up. Kathy Wood is I've given you the name before also. I think it's spelled. I don't know whether it's K or. But you can look up Kathy Wood Tech. You'll get the ARK Investments. You'll get the information. All right. So, so what's happening is what Mike is talking about is that's the kind of analysis that Kathy Wood was doing on Tesla. That looking at the total explosion of the EV marketplace, the size of the market will increase. That they were basically projecting a massive expansion in the EV market. Okay, what you call the sustainable addressable market, SAM. So if you look at that, they were really talking about an explosion of the marketplace, the size of the marketplace, and Tesla being a market leader would be able to grab a significant amount of share. So that was the thesis on which she went long. That she was long Tesla, and obviously it worked out very well for them. But what you're talking about, Mayank, is actually fundamental trading. And typically, then again, if you're doing fundamental trading, you would, in the bigger picture, you would not worry too much about the technicals, right? But of course, at some point of time, if you've locked in gains, if you look at Tesla now, let's say, or let's put it back here, let's go back to Tesla. So somebody like Kathy Wood, who has locked in a lot of gains, let's see, okay? Now, if you look at this chart now, one of the things you can see, if you wanted to look at it from a technical point of view, okay, one place you can see where there's a little bit of a congestion is somewhere on here, which is again applying the simple high-low kind of structure. Okay, so that would really be actually over here, around 330 levels. Okay, so pretty far away from where you are. Okay, so that kind of analysis again you can apply, because again, if you the point that can happen is that because a lot of this move happened without a change in the fundamentals. I mean, obviously something was changing, but it had not come out. The information had not come out. The price had already started to move. That's what happens a lot in equities. You have massive moves without any major change. See, their fundamentals, their improving fundamentals of Tesla has only become clear in about the last 6 months or so. Okay, because they had a lot of production problems earlier. So if you're looking at Jan 21, so really most of the move was over before the accounting statements or even the reported operational operational reporting gave you information on how it's improving at Tesla. So they had a lot of problems with supply, their production targets, and all those issues. So this is what happens in equities. A lot of the price move happens before the fundamentals come out, right? So that's why it's important to also have a technical perspective, because you can just go with a break, and as long as you have a basically okay view on the company, then you can just go with the break and follow the price action. So does that make sense, Mayank? What she's doing actually, what you're talking about is really a fundamental approach, which then should not conflict with the technical approach in the bigger picture. Is this clear? Does that make sense to you?
Yes, sir. Yes.
Okay, so this is a classic example of what you're talking about. You can read up and go and read up on the market reports around this time. This is the time when there was the confusion. Okay, around this time, you can read up the Tesla reports, news reports around basically around second, third quarter 2019, or even going into the whole of 2019 actually. The whole of 2019, there was a lot of up and down in the case of Tesla. As you can see, the price came down all the way. It's from early 2019. The price came down all the way, and then pretty much, if you look at the price action of Tesla in 2019, it's quite interesting. If you look at how the market is digesting news, okay, it's a very interesting thing to look at. You see how it starts December 18, okay, the start of 2019, comes down quite sharply. Then from about the middle of the year, okay, then starts to go up, and by the end of the year, the break is already happening. Can you see that? See, December 18th to December, it's a very interesting move in Tesla for that whole year. So if you go and read the market reports on Tesla over 2019, you will see the shifting perception of the market. And even here, you see the price action has started to move, but the market perception really had not started to move. People were still in denial, and they were saying, okay, how is this company moving up to such a high level? And that's how it works. So it's a very interesting thing to study. Watch how, this is part of the reason I'm giving you these projects, because by training your eyes on this, so Rohit's team will be watching Home Depot hopefully every day, okay, watching all the news coming out about Home Depot, tracking the price movement, seeing how the price is, watch how the price is reacting to the news. This gives you real insight into how the market reacts to new pieces of information. You can form your own conclusion about whether the market is semi-strong, form efficient or not, or whatever, and all kinds of other theoretical positions. So this is a very important, interesting period to study. in terms of how the market perception was shifting. Yeah. So we'll go back. So Mayank is satisfied.
Yes, sir, yes.
Yeah.
Yes.
Okay. So let's go back to where we were on Disney. Yeah, there we are on Disney. All right. So Rahul, your question was you were satisfied with the answer to your question, right?
Yes, I got it, sir.
Okay. All right. Okay. So so good. So this is why you come to class. Okay. So we are spending time on questions because that's very important for me to answer questions, because this is the reason you come to class, to be able to ask questions. Somebody who is just watching the video later on will not have the privilege of asking questions, and that's how you get clarity, by asking questions. Okay, so we don't worry about whether we get delayed in terms of coverage of the material and all that, because answering student questions is very important. Okay. So, so I'm talking about the project brief, so we can have a discussion today about most of it, because this is meant to give you a lot of learning. If you can really put in a lot of effort, okay, you can learn a lot from doing this exercise. Okay, so the technicalities are all, the administrative matters are all written here. Okay. Now, so you will do a buy sell. Now, we were talking about why did I get to that stop loss? The risk point, because I want you to think in these terms. Because in the industry, they don't put a risk point when they, let's put it this way. This can be actually, the risk points can be, I can write this, can be both FA or TA. Be highly specific. Like, so one example of a fundamental risk point for Disney would be that they do not increase subscribers by 30 million in the next 2 quarters. So one of the critical assumptions of your buy rating for Disney is that subscribers, I'm just giving an example, of course, one particular factor doesn't make such a big difference normally, but I'm just giving you an example of how you would state, this is a good habit to get into, because otherwise it's a very airy-fairy kind of recommendation, which is what most of the equity research reports are, because they only give you a type price target and no risk points. So they can be either FA or TA based. The FA based example is, I'm looking at Disney and I say, okay, you buy it here. And however, if over the next 2 quarters, the streaming subscriber growth is not greater than 30 million, then you should sell the stock. Is everyone clear that this is a highly specific, risk point, that the investor who reads this report can monitor this? This information will come out in the quarterly reports, and so the investor can monitor this information and see that if the total subscriber growth is not 30 million, greater than 30 million in the next 6 months, then the investor will know that one of the critical assumptions behind the buy rating has been invalidated, and so the investor will sell the stock. So when you give a purely the FA type of recommendation, risk point, then you're not referring to any price point. So by the time that you figure out that the subscriber growth for streaming is not greater than 30 million, the price might have already dropped to maybe 150 or something like that. All right. You don't know where the price is. You have no idea, because you're not really looking at the price. You gave a piece of information which is kind of fundamental in nature. So it could be, the price could be at 150, it could be at 140, it could be anywhere. All right. So you could also give a purely technical kind of a stop, which would be here, which is based on the idea that, very simple idea. This is a very powerful system, by the way, folks. If you just simply apply this with good risk management, and if you're disciplined about it, you will never lose too much money. If you're disciplined about how much money you put into it, those rules of risk management, which are there in the books I've given you. So you will read those books. The basic principle is that you don't put too much money into one trade, right? So if you go to Macau, with, let's say, $10,000 or $50,000 of betting money. So you don't bet 50,000 on the first roulette, first spin of roulette, right? So if you're going to be at the roulette table, maybe you should plan for, maybe you're going to take like 20 or 30 shots. Then you carve up your risk capital, which is $50,000. You don't put 50,000 on the first spin. You put a small amount, like maybe 3,000 or something like that. Then every time you put 3,000 and try your luck. So that way you can, play for longer. So that's basically the idea, that you don't put everything in one, blow up everything in one shot. So this is actually a very powerful system. So once, and it's so simple actually. There's no, fancy stuff to be done. It's very, very simple. Maybe you can even teach your dog to follow it. The dog will bark. As soon as the uptrend pattern is broken, the dog will bark. So you can actually even, it's so simple. So, a very intelligent dog like Golden Retriever can be taught to even follow this. So now it's so simple, but I'm not joking here. This is a very, very powerful system. Okay, if you follow it in a systematic way, you can see for yourself how much money it would have made. You can pick any stock. If you look at one of the strong stocks, look at Microsoft and see how much money it would have made. There's one break here. Okay, there's obviously one break here. Okay, and this is what? This is the COVID. Yeah, this is the COVID break. Now after the COVID break, look at how it's going. If you this is 5 years. So look at 1 year. Okay, you can see how it's going. Higher highs, higher lows. It's a very, very profitable, can be a very profitable strategy if the market moves in a trend. And if it doesn't move in a trend, then that's why I said in response to Mike's point about Disney at 120, why stop at 120? Don't stop at 120, stop at 160, because this is the earliest indication that your assumptions have been invalidated, right? So, and if you're wrong, fine, you lose money, but generally you don't lose that much money, because you always use the rule that the earliest indication that your assumption is invalidated. This is not the earliest indication. This is the second indication. This is the first indication. The first indication itself, you cut and run. Okay, so this is actually, I just wanted to emphasize. Okay, sometimes people get very confused. What should I do? If you just follow a simple rule like this and you apply it on multiple time frames, it can be a very, very powerful. You have to combine it with money management. And as Buffett himself says, you have to be disciplined about it. Okay, it can be very, very powerful in the sense that you can first apply it here in the case of Disney. If you look at it, you look at the big picture trend. This is the big picture trend. Okay, so you see high, low, and there's actually, okay, from here you can see it's not really a new high. So high, low, and then there is this high, then there is a low, and then there's a high. Okay, and then there's a break actually, because this is taken out. So this one trend from here to here is one trend which has been broken by the COVID low. And in technicals, we don't worry about whether it was COVID low. Now I can see that going by, I mean, this is not to criticize him, but just to understand how his mind is working. Sanchit might say that COVID low we should ignore because it is because of this kind of extraordinary factor. The answer is no. You should not ignore anything. If the market has moved to that point, it is valid for technicals. Okay, you don't worry about COVID low or whatever else low. If the market traded at those points, then those are valid for technical analysis. Okay, so effectively we say that the trend that happened in Disney from September 2002, which is the bursting of the tech bubble. This is basically the bursting of the tech bubble and the internet bubble, and then it comes down and then it starts to rise from here. From September 2002 all the way till January 2020. Okay? This entire long trend of uptrend that was destroyed by that one segment of the trend was destroyed by the COVID drop. Okay, but again from here a new uptrend has started. So on the big picture, what you see is you see one high, you see one low. Then you see a second high. Okay, so you would take these as internal waves. You see a second high. So one high, second high, one low, and there's obviously a low here which we can't see. Okay? Maybe if we figure out, I can't figure out where to get this logarithmic scale here on this chart, but okay, it's here. And now you can see this is all. Now you can see who was asking about log scale. I think Mayank was asking a few classes ago. Now you see how much more detail I can see.
Yes, sir.
Yeah, what happened? This chart is not reacting fast enough. Maybe my hard drive is clogged with too much data. Yeah, I already pressed auto, but yeah, there it is. Okay. Okay, somebody is not on mute. Okay, all right. So now you can see what happens. This is how you use yeah. So this is how you use the log scale. That when you're not able to see this movement, what happened? I can't even see what's happened from 1969 to 1981, etc. So what I do is I switch this off. I go to log scale. Now you can see so much more detail. Can you see that in the long run? So this is where you can see that there was basically this is one high, one low, one high, another low. Then this whole thing is taken as one wave. There's this high, and then there's the low. And now we are going again. So in the long-term chart, you see a continuing uptrend. High, high, pre-COVID high, and then again move to a new high. And so this, if you do that, and if you come back now this will not work because you have to go back to auto. Yeah. So this was your last high, and now we can't even say this is a high because it's not yet really fully established yet. This has also not broken. So now we are in the new uptrend, new phase of the uptrend. Okay, and then we take this. So if you see this, that's what I was saying, that this principle of higher highs, higher lows applied on different time frames. Okay, now we're using a very long term, very zoomed out. So let's use the photography thing analogy. We were totally maximally zoomed out, and now we are quite heavily zoomed in, and we are focusing on the last part of the trend. So you can see high low up, higher highs, higher lows applies to a maximally zoomed out scenario also, but it can also apply to a fairly zoomed in scenario also, right? And we can zoom in more. Here is 5 years. So let's zoom into 6 months. Okay, now it's become too little. Let's zoom into 1 year. See, 1 year you can see a little bit more detail, but it's the same thing to it. Roughly about 160. Okay, so this is the best view actually, but gives us a little bit of pre-COVID also, right? So you can apply that. So because why are you bullish? Let's just do purely technical analysis of Disney. Okay, so Walt Disney, what we have checked in Walt Disney is that it's not like a loss-making company or anything. Okay, it's for fundamental checking, we have checked that it's not a loss-making company. We will see that later, right? So you can see that it's got earnings and things like that. So, and you know that it's got a good stable business. So and then we look at the price action. We see that the price action is quite strong, very bullish. There is a long-term uptrend, and this is the latest phase of that uptrend. And when we zoom into the latest phase of the uptrend here, only this part now, there also we see a incomplete uptrend so far, because we see high, 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 then low, low, here low, another low. We don't see any break in this pattern of higher highs and higher lows. So if we are Aditya, then we believe in momentum investing. So we are, let's say if you are a trend following momentum kind of guy, you say, okay, we should go long here because there's a long-term uptrend which we saw on the long-term charts by looking at using log scale and using all the data. We can see there's a long-term uptrend which has the most recent part of that uptrend is from here, post-COVID low. And so even then, and within that also we have a short-term uptrend which has not been broken. Now, of course, it can break. There's no guarantee just because you buy here that it's going to go up again. It may well go below this. Actually, I think it will. It will marginally break this, but and maybe come to around 140-ish type before it goes up again. But that's just a view, so it could be wrong. But the point is that it can break. But the point is that if you buy at 175 and you put a stop at 160, fine, you lose $15 per share. Okay, and then you can make sure you don't buy too many shares, so that $15 per share into whatever number of shares you buy, maybe 1,000 shares, something like that. So you lose 15,000 only, so that if you're managing a big pool of money, 15,000 is a fairly small amount of money. So that's how you ration your bets and keep it small on each bet. So the point I'm trying to make is that don't discount this method because it's so simple that even your golden retriever can be taught to follow the method. It's a very powerful method actually, and if you can apply it in a disciplined way, you will. One advantage it has is that you will never lose too much money because you will always be out. If you are using a reasonably small scale. Obviously, if you decide never to go, if your viewpoint is always like this, if your philosophy is that I will not zoom in more than this, if that's your philosophy, and there's nothing wrong with that, you can always do that. But if this is your maximum zoom in, what happens is the size of your stops is very big. You're going in at 175 and your stop is around 80. That's a massive stop. Okay, so usually this is one of the reasons why we zoom in, because we can't afford such a big stop on one trade. Okay, so we want to have a tighter or stop which is closer to the market. So we zoom in a little bit more. I say I can't afford that. Okay, from 175 to 80, I can't afford that. Let me zoom in a little bit more. So now I can see a more affordable entry. See, 175 entry and 160 loss, stop loss. So it's around $15. Now this I can afford. Okay, so that's how I zoom. Now somebody who can't even afford this, okay, nothing wrong with that. That fellow will say, no, let me get in a little bit more. Let me get into like 1 year or something and see. So he might say, okay, see, there is a little bit of a turn in the tide here because I see a small uptrend here, two lows, and two highs. Okay, so the moment you have two lows and two highs, you have an uptrend. Okay, please remember that, because all you need is higher highs and higher lows. Two means higher, two means higher, two lows means higher lows, right? We don't say highest, we are saying higher. Higher means two is enough. Remember when we did this case in lab where telegraph lowest offer price, okay, or to telegraph, that, and then so we said in lowest means how many prices, and that was the answer was 3. So here it's higher, so only 2 is enough. So here he can see already there's an uptrend. So he might say, well, I can't afford up to 160. Let me do this one. Okay, a little bit better, 167, a little bit closer to the market. So that's how you proceed, right? So and you can see even this high is actually higher than this high now. If I'm not mistaken, if you read the, yeah, you can see clearly this high is higher. Okay, so you can see here just in the last part here, although this high has not been broken, you see low, 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 and then you see high, high, high. Okay, this is higher than this. So you can see already a developing uptrend. So this fellow will say, why even this? He can actually even say here, this. You read the low here. The low is 170.92. So that means you're getting in at 175 and you're getting out at around 171. Okay, that's only $4. So all of this is okay. All of this is legit. Okay, you can zoom in to fairly low levels as well, as long as you follow the rule that if whatever degree of trend you're looking at, see now what a small degree of trend I'm looking at. Okay, but still there is an uptrend here. You can see the highs and lows. As long as I follow the discipline, yeah, then just hold on a second, okay? Sorry. So pretty much any degree of heavily zoomed in perspective is also okay. You can even go into like 1 month, 5 days, 1 day. There are people who day trade as well. Everything is okay as long as you follow the discipline that if the pattern of if I'm going long, you have to remember the logic. Okay, nothing to memorize here. It's all logic. If I'm going long, that means I believe that the uptrend is still continuing. It is not over. It is not invalidated. It is still continuing. That's why I'm going long. So therefore, if I see any evidence that the uptrend has been invalidated, doesn't matter what your degree of zoom is. It could be this, it could be even 6 months or 5 years or all, whatever. If there's any evidence that the trend is invalidated, then I must immediately get out. Okay, I must immediately reverse my position and sell off my whatever holding I have. Okay, as long as you can follow that discipline, it's not really that big a deal as to which degree of zoom you operate in. Okay, that's based on your comfort level. So here you again notice if you go long here, you're stop using this kind of focusing on this kind of zoom and basically believing that the new uptrend has started from here, okay, and it will eventually clear this, okay, and then you must get out either here or at the worst you must get out at this point because you said the new uptrend is starting from here. So if you use the kind of logic which he was giving earlier when I was pointing at 160 and he was pointing at 120. So if you use a Mayan kind of logic, which is basically let's use a wider stop. We call this a wider stop, and this we call a tighter stop. Okay, we don't say narrower. We call this a tighter stop, and we call this a wider stop. So Mayank wanted to use a wider stop. So, but beyond this is not acceptable. Okay, if you're trading on this view, on this trend, and your view is basically that the decline from here has ended over here, and now we are going to make a new high from this point. Okay, so if that's the case, then this should be your last point. Beyond this, you cannot remain long if it goes below this. And this will be another opportunity for you to exit. Is everyone clear so far about what we are discussing? A lot of discussion on technicals today, but this is a very important aspect of price action. It's very important to be aware of these ideas. So it's an important part of your learning. So nothing wrong with what we are discussing. If you can internalize everything we have discussed, it will be very valuable to you. Okay. So I hope everybody is clear so far. Okay. So this whole discussion started because I was talking to you about risk points. One of the problems of traditional equity research reports is there are no risk points. Okay. So now you understand what are highly specific risk points. All right. So in the case of FA-based risk point, you say if streaming subscriber growth does not exceed 30 million in the next 2 quarters, then you should sell the stock. That is a highly specific, rule. That's an FA-based risk point. The equity research reports don't even give that actually clearly. And or you can use a TA type of stop or risk point and say that if the price goes below 160, then we advise that you should exit your long position. This is clear. Is everyone understood? Has everyone understood what is meant by risk point here in the report? Yes. Okay.
Yeah.
We can ask. Yeah. Okay. Good. All right. Right. So risk point can be either, or you can use both. You can use both, whichever is earlier. The example of both would be that I would write a report in which I would say that exit. So it's possible that the price remains at 180, doesn't move much for the next 6 months. Okay, possible. It remains between 200 and 160. The price just kind of wobbles around, like you can see here also it wobbled around for many years, for many months. Okay, 1 minute. Okay, so in a long discussion, we had a very long discussion. I didn't even realize I could not give you. So I'm just going to just give me 2 minutes. Okay, let me give you the project brief because I want you to start working, okay, on it. This will give you a lot of learning if you do it in a disciplined manner. I will not take too much time, okay. So the report has to contain these parts. I have explained to you what is meant by risk point. Okay, that's your summary section. FA has to include all these elements. You have to look at the 10K, 10Q analysis. Those links are given to you. I'll explain the resources later on. Okay, these are SEC reports that companies have to file. You better get familiar with all this. Okay, Utsav, a lot of these jobs now in India, people in India talk about Indian markets. A lot of the Indian jobs nowadays are KPO jobs, knowledge process outsourcers. And those guys are actually doing analysis for people in the US. So you have to get totally familiar with US markets. Always follow US market analysis on CNBC or Bloomberg. Okay. At night, you will notice the CNBC TV 18 switches to the US CNBC. So you can watch that stream also on TV, or you can watch Bloomberg on YouTube. Okay. Now, get familiar. These are SEC reports. You are required. Utsav was being asked about all these kind of reports also in his interview. Okay, and he's already looked familiar with them because he had the previous job also doing it. A lot of the jobs involve KPO work. You better get familiar with all these reports. Business strategy analysis, you have to have a section on that. These are fairly clear cut. You have to have a trend analysis of key financial ratios. Category wise means today I'll just take a little extra time. Just bear with me because I want to finish the project brief. Categorize means liquidity ratios, profitability ratios in that manner. Okay, so if you go to the FinBiz website and look up the financials under Reuters, it will pull up Reuters financials. You'll see all the different categories. You also studied them in your first year. Last 5-year trend analysis, financial projections, full P&L projections, which you will see in an equity report. You see here, I've given you a bunch of example equity reports. Okay. So if you see here, you will see full spread of financials. Okay, all the detailed P&L, balance sheet, and cash flow. If you look at any of the reports, in this example, you look at the Deutsche Bank report here. Under this, you can look at the report for Disney. Okay. In this, you will see look at the Disney report. Okay, by Deutsche Bank. Just giving an example. Okay. There are many reports here. Okay, all of them will have the same format. The full spread of financials, because these three financials you have to be familiar with. Okay, balance sheet, P&L, cash flow, forecast. Cash flow is again split up into operating activities, financing activities, investing activities. Full revision of your first year work. Fair value estimation, like I've told you. What is your estimation of fair value? Value investors perspective. You'll see a rule on page 23. Okay, tangible net asset value. You'll see the BG means Ben Graham, II is intelligent investor. Okay, on page 23, you'll see this rule of tangible net asset, tangible asset value. Find out what this means. Okay, and you're supposed to check what's the decision based on this rule. Okay, that's your FA section. TA, you have to use multiple time frames analysis, 2 perspectives, momentum, at least 2 indicators. Maybe moving average based, and then maybe a breakout system based. Then mean reversion, at least 2 indicators. One we already discussed, RSI, you can use some other indicator. What is the perspective from the mean reversion viewpoint? What is the momentum viewpoint? Okay, use index citation, APA format, and then all your resources. I've given you a whole bunch of books. Okay, if you can just follow the books that I've given you here. Okay, it took me a long time to put this. I highlight. This is mainly on regression. Okay. But put stuff on regression. Okay, maybe you don't want to do regression here, but that's up to you. You can do regression also. These are very important. Do a company search. Under go to company search, enter your ticker. Then you'll get the. So you click on this company search, and then all these links I've given you. Okay. Here, if you look up, if I'm looking for Disney, I enter DIS. And gives me Walt Disney. Then I click on Walt Disney, and it shows me all the reports. Okay, so I'm taking a little bit of extra time today, but it's a report. I want to finish this job. Okay. Now here you see all the reports: 10K annual reports, 10Q quarterly reports. Okay, so check these. They have a lot of detail. You have to analyze these and get familiar with these because this may come up in your interviews. So other important links, okay. Other important links here. These are some other books that you can refer to. Don't have to refer to everything for this project, but this is a long term. Since I'm not going to be here with you, I've given you all the books that you need to read. Okay, pretty much if you follow everything I've given you here, these resources are meant for you for almost like a lifetime, or at least next 5-10 years. If you can master these books, then you'll be a king and queen. Okay, so for FA, you master all this. Just follow all this. You'll get, just go to pdfdrive.com. I think you'll get all these books. Okay. Then here, technicals. This is a Schweiger's book. It's there in FA also. Then Barry Kaufman, I've highlighted the chapters for you also, which are especially relevant for this report. The chapter highlights are for this report. Okay. Other books, Martin Pring, and this is on classical chart patterns. Okay, this is the classic book actually. Then this is a kind of a more modern book which you can use for your technical certifications, etc. So these are your resources. You can refer to these. You have pretty much everything you need in all these resources. Okay. So your job is now, I'm not going to teach you much more because the objective of this project is it's a you're going to be self-taught here. Okay. I want to see how much each team can extract from the resources I've given you. I'm not going to spoon feed you anymore on this. Now it's your job to read all this stuff and see what you can extract from this and do it on your own. So I'm not going to guide you further on this. I've given you all the resources. Now you have to show me what each team can get out of it and write this report and then submit according to these things. Okay, we may have small discussion. So sorry, I've taken extra time today. All right, so 7 minutes. But okay, now you guys can leave. I'll try to maybe make it up maybe on the last class. Okay, so you're done now. The class is dismissed, and those who have questions can stay back. The rest can go. Yes, Rohan, you have a question. Sorry, I could not see you. So when you have a question, you can just interrupt me because I'm not always able to look at the at the Teams page where your faces and names are showing. So yeah, does Rohan want to go first? He had his hand up, or should we go to Man? Rohan?
Sir, I have a question. Like, we have to interpret the ratios also.
Yes, yes. So you will go and let's look at the, for instance, if you look at here, if I just take in Microsoft, because this is actually just, this is not the financial page. If I go back, actually I'll go to the summary page actually. If I go to the summary page, if I just go to the financials. So you'll have to look at, this is just I'm giving you, you're supposed to look at the 10Q and you have to make your projection. So one of the important books I've given you is, now this is all being recorded, so that's good. Watch for this book, okay? There's a lot of information over here, a lot of resources. I've tried to make it easy for you. I've gone directly to the links in many cases. One book I've given you here is this one, okay? So yeah, this one is a pretty good book for creating the spreadsheets, okay? Because people expect you to be able to do this. Of course, your concepts have to be clear. So you have to put this in the spreadsheet, and you look at, if you look at this report itself, just any of the reports, you'll see how they do it towards the end. Okay, make the projections, use your terminal value, and come up with the fair value analysis. So here we're talking about historical analysis, trend analysis of key financial ratios. You should look at the financials. Okay, all these are the financials. You can see several years now. Okay, so you have to compute the ratios here. Okay, these guys have not given the ratios here, but you have to compute your ratios like, debtors turnover and all those kinds. Those are activity ratios like inventory turnover.
Profit and, okay, sir. Okay, I get
Yeah,
it.
gross profit is not a ratio. Gross profit is here.
Yeah, sir.
Gross profit is not a ratio. Okay, so it's just a subtraction of revenue, cost of revenue from revenue. Okay, or sales minus cost of sales. So yeah, but all your ratios like return on equity, what's happening to return on equity, what's happening to return on assets. Okay, there's a Wall Street likes to use a measure called return on tangible equity. That is related to this concept, tangible net asset value. Find out what it is, and look at that. Do your so here you're supposed to do the trend analysis of the key financial ratios. So a lot of work in this report, but you have a lot of time also. And the more work you do, the better it is for you because it will give you a very solid grounding. That's why I've given you only one stock. I want you to get deep into that stock. Everything you must know, every news that comes out, every item of news that comes out of that stock, you must know, you must watch the price action. Okay, every day, and at least every week you have a look at the price action, do a summary review, and see how the price reacted to the news. Get totally embedded in that particular stock, the one I've assigned to you. Okay, that will give you tremendous learning, and the logic that you use to get embedded into it is going to help you to do any other stock. So today somebody has done, say, Chandra's team does a very good job on PG. They do really good work. Then later on, they can even go into Microsoft or Amazon or Tesla and apply the same process and ask the same type of questions. So the learning will be transferable to other stocks. Okay, so remember that. Try to do your best. I've given you a lot of resources. Okay, tremendous number of resources. This will last you for the next years. I've given you. Okay, maybe 10 years is too much, but 5 years at least. Okay, if you master all these books. So pretty much everything is there. Okay, the other day Tushari was asking about the candlesticks. I think this is the Steve Nissen book actually. Okay, so download this and see. I think this is the Steve Nissen book. So to do these things, so you can just take down these books and do an analysis and learn. So these are your learning sources. I've also highlighted the chapters and try to get down to doing this, delivering this kind of a report. Okay. So remember, this is unusual in two ways. One is equity research reports do not have a technical analysis component, but you should know how to do both types of analysis. Okay. Normally, the technical guy is different from the FA guy, but actually, there is you can combine the two in a different, not in the same time frame, but in the short run, you should give greater importance to PA. Not because it's short term, but because it allows you to get out with small risk. Because otherwise, if you use, you don't use technicals and short term charts, you can lose a lot of money before you get out of the position. So that's not a very good way to manage money because it really constrains your ability to operate because you lose a lot of capital. All right, this is clear, guys. Any other question? Mayank had a question. Okay, Untitled had a question. Yeah.
One thing I want to ask that, so basically, you said that if there is a higher highs, so we can purchase the stock, right? If the higher high is being sustained.
Yeah, that's only if you're a momentum investor.
Yes,
if
sir.
you believe in mean reversion, then you will not.
Okay.
So for instance, if you are like so for whatever reason, let's say Warren Buffett's idea of fair value for Walt Disney is he thinks the fair value of Walt Disney is something like maybe 140 or something. Okay, so somebody like Buffett will not buy Disney at these prices because he's a mean reversion guy. Okay, so if he buys here and he believes in mean reversion, that means the price will revert to the mean, or it will eventually journey to the fair value. Okay, that's the implicit assumption in value investing or other kinds of fair value based approaches. So then why would he buy it? Because now it's much higher than the fair value. So he will not sell it because these are long only kind of approaches. So to qualify, answer to your question is yes, Mayank, but only if you are a momentum investor. If you are a mean reversion investor, then you will not buy because you will be waiting for a better opportunity.
If we will be a mean reversion, then we will be buying at higher lows, right?
Not higher lows, preferably lower lows, but you will be buying. Mean reversion will be suppose your assessment of fair value. Now let's take a more simple example. Suppose your assessment of fair value is say this, say 138. Okay. Now as a mean reversion guy, you will only buy when the price goes far below the fair value. Remember, this is your margin of safety. Whatever is your assessment of fair value is 138. Okay. Then the further it goes below 138, the better it is for you. Right? So you will buy, you will see how far the market goes down, and then you will buy it as far below 138 as possible if you are a mean reversion guy. Right? So you have to be also clear about part of the getting into the investing business in a serious way is to understand what kind of investor you are. So I think based on the limited evidence of one or two sessions or one session, we can conclude that Aditya is a momentum investor. Okay, so as long as he's clear about that, that's fine. So he's a momentum investor, so he will look at the analysis we did for Disney earlier in the class. Okay, long-term trend is up, short-term trend is up, no destruction of the short-term trend, all valid. All the lows are higher than the previous low. All the highs are higher than the previous high. So it's safe to go long. But Aditya has to get out below this. If it breaks below this, he must get out. Okay, if you can do that, that's a fairly good system. And with this kind of approach, you will never lose too much money. And one of the problems that happens in the market is that people have very poor risk management. Most investors have very poor risk management and they don't have a plan to get out. So the point is that before you get in, you must have a plan to get out. Okay, you must know at what point you want to get out. Okay, and this is one of the advantages of TA over FA. That in TA, you see how it is. So I gave you 2 risk points. In the TA risk point is 160, very specific. I'm entering at 175, and the loss is and the exit is 160. How do I do it? I go to my IPM calc. So what is my entry price? Let's take this. What is my entry price? If I take my entry price here, okay, how do I do it? Very simple. Okay. So if my entry price is 175 and my exit price is 160. So what is the formula for the P&L, folks? Can anyone tell me? General formula, always valid. P&L calculation, what should be my general formula? Anybody?
Sir, exit price minus entry price.
Okay, correct. Exit price minus entry price. General formula. Doesn't matter whether you're trading foreign exchange or you're trading equities or you're trading bonds or trading commodities, always the same. Exit price minus entry price. So we always want to study in general principles. What happened here? Oh, I went to the text. While I'm lecturing you guys, I went to the text. Instead of going to the number, I went to the text. Okay, so $15 per share. Okay, now suppose my total capital is, say, total risk capital, let's say. Okay, so just write capital. Okay, total capital is say just write risk cap. My risk cap is say let's take a simple example, 100,000. Okay, my risk capital is only $100,000. Now I don't want to lose. Should I risk 100,000 on this one trade? Yes, anybody? Man, should I risk? How much should I risk on this one trade on Disney? If my total risk capital is for the whole year is $100,000, how much should I risk on this one trade in Disney? Mayank is not here. Okay, so let's ask Aditya. Yes, Aditya. Your audio is not working. Okay, let's ask Malika. What should we risk? 100,000 is my total capital for the whole year. How much should I risk on this one trade in Disney?
So, $1,000.
Okay, fine, no problem. $1,000. So what Malika wants us to do, risk per trade. There's no right answer, wrong answer here. There is only a question of more right or more wrong. So if somebody said $90,000, that is more likely to be wrong than right. Malika is closer to being right because she's on a very low number. So she has looked at this figure of 100,000. So she's saying, okay, let's only risk $1,000 per trade. Okay, risk is $1,000. So how many shares can I buy? Sanchit? How many shares can I buy? Malika has told you you can't lose more than $1,000, and I have told you that your entry is at 175 and your exit if you get stopped. If it keeps going higher, then of course good for you. Okay. Then but we have to always plan for the worst case. Okay. If it goes in your favor, there's nothing to worry about. But you need planning for the worst case. So you know that the loss per share in the worst case is $15. Now Malika has told you you can't lose more than $1,000. So how many shares can you buy? What is the formula? Number of shares? Anybody? Yes, Malika can tell us.
The 1000 divided by 15.
Okay. So it should be. We want to make this absolute. So right. So now you see this. So we have to round it. So this means you can only buy 66 shares. You don't buy 67. And of course, remember that we are not adding commissions here. You have to add the commissions also. Okay, so the simplified example. Of course, nowadays you can trade without commissions and you can trade in odd lots. So if you trade on Robinhood, this is good because no commissions and you can trade odd lots. Normally in the US markets, our round lot is 100 shares. So you would normally not trade when you're trading for an institution. You don't trade 66 shares. You trade lots of round multiples of 100. But nowadays you can trade on Robinhood for zero commission and odd lots, but not 67 shares. 0.67 you can't do. So here you have to round down to 67. So this should be written as actually the formula should be written as how? What should we write, guys? So this will actually round off to. No, we have to round it off. I was going to write integer. Integer may not do it because integer might take you to 67. If you write integer here, it will round off and take you to 67. Alright. It is okay. Fine. It is rounding down. Now you see this. Number of shares is 66. Yes, everybody is clear? Malika, you're clear?
Yes, sir.
Okay. Yes, Aditya? We are not able to hear you actually. We can see your hand is raised, but we are not able to hear you.
Sir, please mark my present.
What? I could hear you.
Sir, mark my present. I am joined with you.
No, I think you were marked present. I don't think you were marked absent.
I am Ankit Jain 1.
Ankit Jain 1, now that is an assumption, that has already gone. No, you have to be present at the time of attendance. Now
Sir,
we'll take it up. Now we'll take it up later. You have to take it up with the PGDM chair, okay? Because I can't follow a special rule then that today you joined 15 minutes late. Now somebody else will join 35 minutes late. Now how do I say to that person that I won't consider yours, but I considered Ankit's? So you have to join on time. You have to be disciplined. So to take today as later on, you can take it up. I'm uploading all the attendance logs from Microsoft, from MS Teams. I'm attending all the, for your information, I'm attending the logs, okay? I'm uploading the logs also into a drive file and I will share that with the PGDM chair. So later on at the end of the course, when I give my final report, and then, so this will happen before the exam, okay? When they decide to see who is going to be debarred and all that. So at that time, if you feel that you joined like maybe just after the attendance was done or something, so I can't take care of that. She has to do it, okay? So what I will do is I will share that with you, and I will share that with the students also. I mean, I'll share that with her, and I'll have to check permission. I don't know if the institute will allow sharing with students, but I'll have to check with them. But I'll share it at least with ma'am. And then if you know when you joined, and if you feel that there is some case you have, you just go and approach her, and then she can decide.
Okay, sir.
Okay. I can't decide. I have to take the attendance at some point. I take it at 5 minutes. I give you 5 minutes grace, and by that time you have to be in. Okay.
No.
All right. Is that reasonable? Okay. Good. I'm glad to see that you're reasonable. Although the decision is not in your favor, but you feel it's a reasonable approach. That's good. Okay. So yes, anybody else? Any other? So now you see something here. We took a lot of decisions. Huh? We decided where we entered, where we exited, and we also took a decision on how many shares to buy. Okay. So if you follow this kind of discipline, you can never lose too much money. And one thing you have to note is, okay, how many? So what is the risk per trade as a percentage of the risk capital? Okay. So Malika is a very conservative investor. Nothing wrong with that. This is perfectly safe. Nothing wrong with this. Okay, 1% is perfectly fine. In fact, more than 4% will be quite dicey, according to me. Okay, so this 1% to 4% max. Anything beyond 4% becomes quite aggressive. So what Malika's instincts are very correct. She's very conservative. That is the right way to do it. This way you ensure that the market can never destroy you. If you follow this discipline, the market will never be able to destroy you. Otherwise, most of the time, what happens is they get in without any plan and then they get smashed. The market basically takes them out. Right? Okay, any other questions, folks? Yeah, nothing? Okay, so we'll end it here. Okay. All right, so I'll stop the recording. Stop recording.